Welcome to part 7 in this series. In this 7th part of the series, we will be focused on internal financial reporting to the board. First, we will recap the importance of transparency, accountability and compliance in board financial reporting. Secondly, we'll consider best practice in financial reporting to the board. Finally, we'll look at the purpose of a budget and the considerations the board should have when reviewing and approving the budget. In part 1 of this series, we learned that the directors have a key responsibility to establish a culture within the organisation of transparency, accountability and compliance. This is particularly true when it comes to financial reporting to the board. The ACNC Act imposes various duties on directors, who the ACNC refer to as responsible people. These duties include the duty to act with reasonable care and diligence, the duty to ensure the financial affairs of the organisation are managed responsibly, and the duty to not allow the organisation to operate while it is insolvent. Directors should set the tone from the top and consistently emphasise the importance of sound financial stewardship. As a director, we should establish a no surprises expectation with the CEO, the finance manager, and the wider management team. Every significant strategic or operational decision by both the board and management should be made with the consideration of the financial implications. Financial reporting to the board is ordinarily done through the provision of management accounts, accompanied by reports from the CEO or finance manager. The board should set clear expectations of management about the form and content of these reports. The management accounts provided to the board should be calculated in accordance with Australian accounting standards, including the recognition and valuation of revenues, expenses, assets and liabilities. In this way, there will be consistency in the reporting of the financial position and performance between the internal management accounts produced throughout the year and the external financial statements which are produced at the end of the year. However, the board has the complete flexibility to determine the format and level of detail received in management accounts. It is important for directors to be mindful that your role is governance and oversight, not day-to-day management. You should avoid moving too far into operational detail and overstepping your role. Management accounts should be prepared in line with the board meeting calendar and circulated to the directors in advance of board meetings. They can also be prepared monthly, quarterly or on an ad hoc basis if required. Best practice for management accounts and the accompanying CEO or finance manager's report would include the following: an income statement showing the results for the month or quarter and year to date. These should be compared to the budget for the same period and the actual results in the equivalent period in the year before. The CEO or finance manager should provide an explanation of any significant variances between the actual results and the budget. A balance sheet at the end of the period and a statement of cash flows covering the period should also be provided. In addition to these look-back statements, best practice board financial reporting would also include some key look-forward reports, including a full-year forecast for the income statement and a cash flow forecast for the next 12 months. The accompanying commentary from the CEO or the finance manager should give further insight into the operating and financial performance of the organisation. This would include how the financial resources are being used to achieve the organisation's objectives, including the financial impact of any strategic initiatives, for example, new artistic programs or fundraising campaigns. It should also include a discussion on key financial risks, for example, reliance on one source of funding or donor concentration. These should also be linked to the organisation's risk register. If the organisation has a board-approved strategic plan, the reporting could include a dashboard for tracking key performance indicators and financial ratios. We now turn to budgeting. In an arts and cultural organisation, the annual budget is key to ensuring the organisation can deliver its creative mission sustainably, responsibly and transparently, while also building and protecting its long-term financial viability. The budget serves many purposes. First, it shows how the organisation intends to deliver its artistic plans and the allocation of resources needed to achieve them. Second, it helps to ensure the financial impacts of artistic decisions are understood up front. Third, it assists in planning for the right mix of income sources such as ticket sales, grants, sponsorships, etc. Finally, it also allows the board and management to understand fixed versus variable costs, seasonal spending cycles, and cash requirements. All of this provides support for decisions about what is viable or what might need to be deferred. It also encourages transparency in the trade-offs between creative priorities and financial constraints. In addition, a budget demonstrates accountability to key stakeholders, such as government funding bodies, that their public funds will be used responsibly and for the intended purpose. The budget also allows directors to monitor actual performance against the plan, which supports the board's duties to ensure responsible financial and risk management. The board and management should agree on a budget process and timetable well before the new financial year. The budget should be circulated to the board in advance of the board meeting at which it will be considered and approved. As a director, you should ensure you have allocated the appropriate time to review the budget. When reviewing the budget, directors should consider the following things. Does it reflect the expectations of key stakeholders, the purpose of the organisation, and the agreed priorities? Are forecasts of the various types of revenue realistic and evidence-based? Is there an over-reliance on a single funding source, particularly if that source is insecure? Are expenses explained and sustainable? Is the allocation of funds between the delivery of the artistic program, administration, and fundraising costs appropriately balanced? Does the cash flow forecast show that the organisation will have enough cash to pay its liabilities when due? Has the management team stress tested the key assumptions, for example, audience numbers? Have management planned for difference scenarios if the underlying assumptions change? Are there adequate unrestricted reserves to cover risks and unforeseen disruptions? Are there clear financial and non-financial measures to monitor spend against the budget throughout the year? To summarise the key learnings from this part of the series. First, we highlighted the importance of transparency, accountability and compliance in board financial reporting. Second, we considered what best practice in board financial reporting looks like. Finally, we understood the purpose of the budget and the considerations the board should have when reviewing and approving the budget.